This is the Empowering Healthy Business Podcast, and I'm your host, Cal Wilder. Each episode, we'll dive into topics important to folks who want to run businesses that are both nicely profitable, sustainable, and scalable, and who want to achieve balance in their lives and realize their potential inside and outside of work. This show is sponsored by SmartBooks, provider of bookkeeping and accounting for businesses. Let's get started. Hey, Greg, welcome back to the show.
Thanks for having me.
Hey, I know tax season is starting to heat up for you. We're recording this the first week in February, so things are getting hot for you, right?
The IRS opened for business last week, I think. I've already filed a couple of returns, so yeah, we are in it.
Awesome. So, what do you want to talk about today?
You know, it's tax season, and this is when a lot, or pretty much every business owner, taxpayer starts talking with their CPA. And so I kind of wanted to just touch on, things that your CPA should be telling you, but maybe he isn't. And, it's not that they're trying to hide this stuff from you. It's that, the system is just kind of built for to be more reactive than proactive. We're trying to file a lot of returns this time of year. And so if this is the only conversation you're having with your CPA, you're probably leaving money on the table.
Right, because you don't have time to do intricate planning and everything right now. You're trying to crank through a whole bunch of returns for a whole bunch of clients that want their returns filed on time.
Exactly. And, this time of the year, I'm pretty much just a factory worker putting numbers in boxes.
The time to do planning is what, the other 9 or 10 months of the year, right?
9 or 10 months out of the year is perfect time to do tax planning.
Cool. So, what do you have, a list of top 10 list or?
Yeah, my kind of top 10 list, things that you should be thinking about, maybe conversations that your CPA should be having with you, that you should maybe be having with your CPA. I don't want to say red flags, but if you're not having these conversations, then maybe it's something to think about. Is your CPA working for you, or are they working for the IRS?
Hopefully for you.
So number one, tax prep versus tax planning. I talk to a lot of clients that say, or a lot of taxpayers who say, my CPA is great. He gets my return filed by, February 4th, and, I get my refund by February 7th, and, it's awesome. But, the problem with that is that even if they're great at filing taxes, maybe they're not great at saving you money. So even if you have a good relationship with your CPA, even if they're getting things filed on time, it's really important to know that you're at least, ask questions, keep them on their toes. Am I saving enough money? If they put you on extension, then, maybe that's what it takes. We'll get to that in a little bit, but, that one conversation a year just to try to be the first person to get your taxes filed isn't always the best thing.
All right. What's next?
Not all tax savings opportunities are created equally. So, you have deductions and you have credits, and you have deferrals and you have reductions. So a deduction is a reduction in your taxable income, while a credit is a deduction or a reduction of your tax.
So credits are worth, dollar for dollar, right?
Deductions
are worth, 30 or 40 cents, right?
Whatever your tax rate is. And so, and I'll preface this by saying I sometimes advise clients to do this with an asterisk, but I do say it. But, sometimes if your client's just talking to you throughout the year and just telling you to go buy stuff, the whole go buy a truck at the end of the year thing, that's not necessarily effective tax strategy. So just something to be aware of. If that's the only tax strategy that you're getting from your CPA, might be worth exploring other options.
Yeah, spending a bunch of money at the end of the year, you're right, it does reduce your taxable income, but you don't want to spend a dollar to save 30 or 40 cents. So you want to make sure
Yes.
it's a good investment for the business. That's what I always tell clients. Make sure you're not just wasting a dollar to save 30 or 40 cents. Make sure it's something that you would have bought anyway. You're just buying it a little sooner.
Yep, exactly. I always say if you got to buy inventory or something, you get some jobs coming up, and they're kind of locked in. Yeah, this is a great time to do it. But I mean, at the end of the day, it's all a deferral, not a tax reduction. So
And I
keep
think
that in
that's
mind
an
too.
important point, right? Because you can defer tax into next year, you can accelerate depreciation, but now you've taken all your depreciation deduction now and you don't have any left for the future. And so it's not always the best decision to minimize this year's tax tax bill, right? So what kind of
Yeah.
considerations go into this idea of when it makes sense to accelerate deductions versus let them run out over time?
You got to really look at taxes over a multi-year period, not just 2024 taxes, 2025 taxes. Um, and the idea is really income averaging. You really want to keep your income consistent year over year. If you have some years where your income's way down because you bought a bunch of inventory, but then the next year you don't have that expense, now your income's way up. You might be launched into a 37% bracket, and that's doing no one any good because now you're paying 37 cents on every dollar at that level.
Right, right. So you can have a bad year, in which case you probably don't want to accelerate or do anything to reduce your taxable income in a bad year.
Yep.
But if your profit margins are real fat, the next year, maybe that year you do want to do some tactics to reduce your income, right?
Yeah, bonus depreciation's a big thing right now. Everyone's trying to take like that big deduction. Um, Not necessarily always a fantastic idea. If you had maybe a down year, you bought a bunch of inventory or a bunch of assets, and then you're looking at next year, and your income's going to be way up.
Like you said, it's about kind of managing the multi-year income to avoid, if you can avoid getting bumped up into the highest tax brackets every now and then by averaging it down, that's what you're saying, right?
Yeah, exactly.
Cool.
And then on the other end of the spectrum, sometimes paying more tax is okay. Um, Banks like a juicy tax return. So if you're kind of planning on aggressive expansion, you want to get some loans, you're going to want to make sure that your tax return is showing some higher income. You're going to want to make sure it looks very healthy, which means that you're going to have to pay a little extra tax. It's kind of just the cost of doing business, unfortunately.
Yeah, some would argue that the size of your tax bill reflects how profitable and successful your business is, right? So you should be happy to pay a high tax bill because it means you made a ton of money. But most people
Not
don't.
too high,
Most people
but
don't
yeah.
really want to pay too much of a tax bill.
Yeah, no one likes that advice, but unfortunately I've seen it happen where clients come back to me and say, "Oh, I really need to have a solid tax return this year. It needs to look good because the bank denied me, and I need this funding." So um, they don't always like when I give them the tax that goes along with that, but unfortunately, it is what it is. Um, and then another thing that, or I guess two things we'll combine two here, but owner compensation and entity structure. If you're not having these conversations with your CPA on at least an annual basis, um, you might be leaving money on the table in some way, shape, or form. Um, the tax laws change a lot, at least every 4 years. Um, and sometimes different structures make more sense as the business continues to grow and change and evolve, certain structures make more sense. And so, I'm actually in the process of doing several S corp to C corp analyses for clients right now because we're kind of evaluating, like, does it make sense to be a C corp versus an S corp based on the goals of the company, where they are at financially, where the owners are at personally, stuff like that. So, I mean, these are all clients that I had advised that S corp is the way to go several years ago, and now I'm coming to them and saying, well, maybe that's not the same advice anymore.
Are there any particular situations where if somebody does have an S corp? Because I'm always of the mindset that over the years that S corps are usually very tax efficient for service industry type businesses to avoid certain payroll tax liabilities, right? But there's some situations when the C corp is more advantageous. Is there any kind of
Yeah,
general rules of thumb you could provide?
it's not necessarily that the S corps are going to be less tax advantageous. I think most of the time S corps are going to be tax advantageous. It comes back to looking at the bigger picture. If you're trying to bring on investors, if you want to have a second class of stock, um, a C corp is going to be much more advantageous for you. Are you going to pay more tax? Probably. But there are also ways that we can try to get that down. But and then there's the small business stock exemption. So you hold the stock in a small business for 5 years. The capital gains or a portion of the capital gains can be taxed at 0% when you go to sell it. And so that's another thing that we consider. Exit strategy. Does it make more sense? It's also easier to transition a C corp than it is an S corp. So something to think about. So these are all things that we are constantly evaluating with our clients. Does it make sense? And if it doesn't, great, but at least we're thinking about it. And same with owner compensation. I know I kind of blew past that, but general rule of thumb, if you're an S corp owner, the idea is that you pay yourself less compensation and more in distributions. But if your big goal is retirement planning, then that might not be the best strategy. So, because a lot of 401k SEP plans are dependent on your wages rather than what the business is doing. So, things to think about. What's important to you as an individual. And so these are all conversations that we are having with our clients to make sure that the tax strategies are aligning with their overall goals as people.
Makes sense.
And I talked about extensions. If your CPA ever tells you that an extension is for a tax strategy, it's probably a lie. And Cal, I know how you feel about extensions. So
I hate extensions, but sometimes it makes sense, and you just have to go on extension. But right, as you always tell me, it's not an extension to pay; it's just an extension.
It
to
is not an
file.
extension to pay. Yeah. So you still gotta set. If you're gonna owe money, you still gotta send that money in, or at least 90% of it. And does it make sense sometimes? Yes. Do I advise some clients to extend? Absolutely. If you have a complex return, maybe we're waiting on some information. We're waiting for a company to do an R&D study, stuff like that. Then 100% makes sense to extend the tax return. But it is hard to do tax strategy or tax planning when you extend your tax return, because it's all historical data. And I think it's important to note that even if you do extend your return, you can still do tax planning for the current year. So you should still be having those conversations with your CPA throughout the year. If it's June and your tax return typically doesn't get filed until August, you should still be having a Q2 meeting to talk about Q2 estimates, tax planning strategies, stuff like that. And then along with that, year-end planning doesn't necessarily mean that you have to do it at year-end. I strongly encourage my clients to meet with me at least twice a year. Once in June, July, and then obviously once at the end of the year, where we can at least have those touch points, see how things are going, get a pulse on the business, what's going on. Sometimes it's really hard to remember what happened 12 months ago. It's easier to remember if something happened only a few months ago. So, and it's good to have those conversations with clients.
I assume, just like business owners don't like surprise tax bills at the end of the year, I assume you CPAs don't like, surprise new information that you find out only at the last minute when you go to file the return that you wish you knew about 6 months ago, right?
Yeah, I mean, there's definitely times where it's frustrating where, you might find out that a client started a new business, sold a business, and you're finding out during tax time. It might have some serious implications, but for the most part, sometimes I just feel bad because I'm like, oh, if you just told me, I could have, advised you to do it this way, and we could have saved you a bunch of money. And taxpayers, they don't know what they don't know, and sometimes they just don't think that it's information that's necessary for me. But that's why I like to charge a fixed fee for my tax returns, and I'm usually pretty lenient on my billing because I want to promote that conversation. Some of my most successful clients are the ones that just shoot me a text here and there and just say, hey, this happened, or do I have to think about anything? And that's the really extent of the conversation, but at least we're having it. Let's see. Safe harbor estimates. Some people I talk to say, I don't need to talk to my guy. He gives me the estimates. I pay them, and then we file the return and we true everything up at the end of the year. Safe harbor estimates are safe. I'll tell you that. We do have clients that pay. We give them the 4 estimates, and we say, see you next year.
And the safe harbor calculations are based on the prior year.
They're based on the prior year.
So as long as,
if you're going to have a
amount,
consistent
you
year,
penalties, but the risk is what?
Yeah.
You overpay because something's different.
Well, the risk is that you overpay. Yeah. And so the idea is that, if you're trying to expand your business, you don't want to be using the IRS as a interest-free savings account for the next 12 months. So ideally, you're doing that planning with your clients to come up with Q2, Q3, and Q4 estimates that match how you are doing that tax year rather than how you did historically in the prior tax year, especially if your business is growing rapidly.
Which is why you like to talk to your clients a few times a year, just try to stay on top
Exactly.
of that, right?
Yeah. I mean, we have one client that they just started last 20, beginning of 2024. I mean, in year one, they did really well. And I think they showed about 400,000 of net income passed through to them. This year, they're going to show about 1.5 million. So if we had paid estimates based on 400,000, that would be a really rough tax bill to get. Also, not a phone call that I want to have.
I'm glad you can laugh about these things, Greg.
Well, I can laugh about it because I'm on top of it, but if I wasn't, I'd be trying to figure. I'd be hiding, actually. You know, and along those lines, conversations should always be a two-way street. Don't assume that your CPA is always going to reach out to you. Like I said, our business model, unfortunately, is built to be reactive rather than proactive. You know, I think we're trying to do a good job of staying ahead of that, but there's always going to be times where, you know, tax season where, you know, we're just going to be a reactive partner in the relationship. And it's important that, you know, we're reaching out to you, but you're also reaching out to us, you know, should things change throughout the year. Did you start a new business? Did you, you know, have a kid? Did you get married? You know, things like that are all important to tax planning. And then finally, you know, I get some clients that come to me, and I've lost some clients that they say, oh, you know, I saw this thing on TikTok and it sounds like a really great tax planning opportunities. Guys don't pay any tax. Or, you know, my CPA didn't bring any ideas to me, and, or, you know, for the last couple of years, and I just think I'm paying more money in taxes. And, you know, I'll say that yes, if you're not having conversations with your accountant, then you might feel like they're not doing their job to be proactive, and that might actually be true, and that's why you want to have those conversations. But I'll be honest, I used 5 or 6 of the same tax planning opportunities amongst 95% of my clients. They're effective. You know, they're more or less audit proof, assuming you document everything correctly. And we, you know, we've had a lot of luck with them, and it can be boring, but sometimes boring is good in the tax world.
I will say I've been, you know, owning my own businesses for 25 years now, and I always talk to other business owners, and there's this belief out there that there's a way to avoid paying taxes. But I've been looking hard for 25 years, and I haven't found a way to avoid paying taxes. I don't think there is a way to avoid paying taxes legally.
Yeah, I always feel bad when, you know, people come to me and they saw something on TikTok, and I'm like, oh, yeah, no, that's not how that works. That's, you know, we'll call that clickbait. But sometimes they're decent. You got to kind of look at who's giving the advice. But
All right, so you walked us through your top issues list, and if I were to sum it up, I'd say you want to be talking to your CPA a few times a year, not just in Q1 when you need your tax returns filed, right? It's
yeah,
a two-way communication street. Have those conversations over the course of the year. Keep your CPA informed about new developments in your business and your life, so that the CPA is in a position to help you the best they can. They can
yeah,
only
and,
help you
you know,
based on what they know.
book those meetings during, you know, if you're talking to your CPA at tax time, book those meetings, you know, when you're filing your tax return, and they don't have to be set in stone. They can change, but at least, you know, they're on both your calendars.
Great.
Yeah.
Well, thanks for joining us, Greg. If somebody wants to reach out to you with tax questions, what's the best way for them to do that?
So you can shoot me an email, greed at smartbookstax.com, or you can go to our website, smartbookstax.com, and you can book a meeting directly on my calendar there.
Awesome. Thank you, Greg. This has been another exciting episode of Empowering Healthy Business. We'll talk to you soon, Greg.
All right. Have a good one.
Another episode in the books. Thank you so much for tuning in. For show notes and more, visit empoweringhealthybusiness.com. If you would like to have a one-on-one discussion with me or possibly engage SmartBooks to help with your business, you can reach me at C-A-L, at empoweringhealthybusiness.com or message me on LinkedIn where I am easy to find. Until next time, this is Empowering Healthy Business, the podcast for business owners, signing off.